Hey, good morning, everybody. Happy Monday. What's going on? We're back with another Playbook Small Carrier Market update where we break down what's actually moving in the freight market for small carriers specifically. We're breaking down high frequency data and really bringing it down to the most common denominator level so we can help you understand what's happening, what's moving, and the decision that you make. Whether you're operating one truck, five trucks, or dispatching, this is your 5 to 10 minute update that gives you that opportunity to see what's shifting, what's happening, where the money is, and how to move smarter. We're not here just to throw theory or anything at you. We just want to talk real data, real talk, and just some real strategy you can use this week. So let's lock in. Let's talk volume. Let's talk fuel rejections. Let's call that stuff and whatever it means for your trucks and your wallets. But before we get started, most importantly, I wanted to just to take a minute to lend a thoughts to those that are being impacted by the storms in Texas. Just a tragedy down in that area, and my heart really goes out to those children and the folks that are lives that are impacted by it. So definitely wanted to take a minute to recognize that, and I hope to bring some. I hope there's a resolution that's brought soon and there's peace. So just looking forward to just peace and comfort in that area. Now, as we go into this week, I want to go through a couple of different scenarios with you, give you an idea on what's happening and see exactly what's going on, especially when it comes down to projecting this forecast maybe a couple of weeks down the road. So number one, let's look at the outbound tender rejection index. Now remember the outbound tender rejection, if you've been following this series for the time, you know that outbound tender rejections are contract tenders that are being rejected and they end up spilling onto the spot market. Well, our rejections right now are climbing. That means that more spot is hitting that load board, more freight is hitting that load board. So if you can see the chart now, if you compare where we were in mid-June and end of June to now, we're in that 7 range, which is the highest that we've been since, I mean, you want to look back, you want to go back to February at 7.72. This is telling us that there is tightened contract capacity. Obviously, we want to keep our eyes on it because that means more freight is being spilled into the spot market. Will you see an immediate direct impact today? Probably not in every market across the country, but incrementally you'll start seeing things getting better over time as what we call capacity. And as you know, capacity means the available trucks that can be loaded. As that shrinks, then you can actually start seeing those rejections start to increase. You'll see a market improve. Now, one of the things that you can obviously say that it's a seasonal surge, right? We're in the 4th of July. You know, we got some key markets that are being impacted by the 4th of July, weather, things of that nature. So you know that some of that spilled into it. But then there's that always that when as that capacity starts to bleed down and those rates start to peak up, then that means all those rejections starts to pick up as well because you got contract carriers or contract tenders that you might find a better opportunity on the spot. So that's the thing that you got to look for when it comes down to it. Now, the next thing that we look at is the outbound tender volume index. And OTVI, I've talked about this before too. Just in layman's terms, this is the amount of freight that is available on the market. The higher the OTVI or the outbound tender volume index, the better off rates can potentially be because that's more freight that goes into the market itself. Now, our current index 10580, that's up 2.15%, right? So we're still around that 105 area, that mode, and we've been around that mode pretty consistently for this I would say half of the year. We have some dips right after Memorial Day, surge right after Memorial Day. When we had the tariff announcement, you saw a dip there, dip of sub 9,000. But now we're starting to see some incremental growth in that. We're holding steady in the narrow band. It's not crashing, but in order for us to see sustained rate increases, we have to see volumes increase as well. So I want to watch closely this week because last week was driven heavily by getting freight on the marketplace for the holiday. I want to see what it looks like after the 4th of July. So next Monday, I'll be really interested to see what it looks like on next Monday. So I'm looking forward to that. Flat doesn't mean it's a bad market it's not bad for where we are in terms of a market like this, but it's something that I want to keep an eye on. The next thing I wanted to look at is your National Truckload Index or your NTI, the 7-day average. This is the average spot rate over the last 7 days. So they are climbing. So as you can see from mid-June all the way through July, we've seen a constant climb. So they remain to just incrementally incline. And now one thing that you definitely want to consider, okay, I get it. We got through a holiday. So, next week's really this week, honestly, is really going to help us tell a story. But this is an opportunity for us to start seeing, hey, what is the market going to traditionally look like over the next couple of weeks? What can I expect to see as I operate out there? We saw that mini spike in June. We've seen it soften a little bit, but I want to see what rates look like at the end of the week this week, and then be able to make a better determination as far as momentum. So I would say that as we're into the fourth, I wouldn't bank on a major run up this week, but I would say that there's going to be some pockets and some areas that are going to be volatile, specifically on the West Coast, and I'm going to tell you why here in a minute. Now I want to shift to overall diesel fuel prices. We're finally seeing the diesel fuel prices shake down just a little bit at 372. It's been a roller coaster of a month from June all the way to the beginning of July. We started off June at 345, and now we're at 375, which is a 30 cents increase. And we saw it go up 5.5% just over the last week. It's definitely, probably, more than likely tied to what's happening with global oil concerns, and then just some of that little stability there. But I'm hoping, and I'm not going to go in here and just claim to be an energy expert, because that's not my lane. But that's something that I want to watch over the next couple of weeks as some of that geopolitical instability subsides. I want to see what happens with our diesel pricing here in the U.S. So it's something that I'm definitely going to watch. Obviously, you're going to be the one that's most vulnerable to these fuel price swings because it directly affects you. It directly impacts you. But there's two things that I want you to be mindful of when it comes to fuel. When it comes down to fuel, it's a controllable variable expense, right? So even though it's a very, very big expense for you, there are some control parameters in it. You have two control parameters: station selection, right? That's how you choose amongst your fuel planning, which stations you choose, how much you're paying at the pump. And the second thing is the actual consumption of fuel on your tractor. We have tractors out there that are consuming in the high 9s, and then we have tractors out there that are consuming in the low 6s and low 5s. So there's a wide range of consumption when it comes down to it. So that all plays a part into that. So make sure that you're diving in and you're doing a deep dive on all of your controllables when it comes down to consumption. Make sure you're staying on top of your maintenance. You got proper tire inflation. One of the things that we saw for a lot of clients was that seventh injector was causing a lot of issues when it comes down to overconsumption. So make sure that you stay on top of those little things like that to help ensure that you're getting the best fuel possible when it comes down to consumption. And when it comes down to station selection, y'all, don't treat this like you're driving to Disney World, right? You want to make sure that you're planning ahead. Look at your plan ahead. And there's some tools out there that lay out station costs and station prices along the way. Man, when I started, we had to trip plan. And when I mean trip plan, we had to look out a map. We had to write down every fuel stop, man. Get down to the basics, because this is going to help you. Every penny that you can save can help you get through market swings like this. And I just wanted to make sure that you're using the break-even calculator that we provided. If you're on contract freight, make sure you understand the fuel surcharge practices and you're using it properly. And if these global tensions escalate, which we don't know, none of us knows. I mean, all of this is all nothing but speculation. If anybody tells you they have the answers to what's been going on in the world this year, they are straight up lying. We are all making guesses out here. So if tension, and I'm just going to say if tension escalates, prices can escalate above $4. So just want to make sure that we be prepared for that.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. The people that I see most successful in this business operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the Freight Waste Playbook.
Next thing I wanted to share with you is a little bit of activity. As you can see, just about the entire country is in the blue. Now, this is over the last 4 days. And remember, the last 4 days was holiday related. So I expect these things to shade back to their normal colors, right? We're going to go back to some reds, some pinks. We'll have some white in there. And then we'll have some areas that are going to be deep blue. And then you're going to obviously see some balance there. So it's really hard this week to give you a really, really good, clear indication on what we would say would be, hey, these are going to be the best markets until things burn off a little bit from the holiday standpoint. Right now, it just looks like Papa Smurf, honestly. Like you can pretty much go anywhere, and we know that that's not the case. But at least what I want to do is provide you with some of the red zones in here. So that way you can stay away from certain areas like your Houston areas and things of that nature that have declining rates in those last 4 days. So that way that you can do your best as far as position is concerned. Unfortunately, just because of the holiday, it just threw up an anomaly when it comes down to data. I wanted to give you the real-time information so you're seeing it real. Monday, Tuesday, Wednesday, we'll be able to have a better opportunity to understand exactly what's going on. But it's an opportunity across the country, obviously, as things kind of bleed out. So keep your eyes open when it comes down to that. For my reefer carriers out there, ROTRI, right? Your reefer outbound tender rejection index. It's the same thing as the outbound tender rejection index, but I promised you that I would throw this in here too as well. Reefer rejection rates are trending above dry band. We're going to see another increase. We have seen another increase. We're up now about almost 1.5% to 11.9% rejection, which is really, really strong. Obviously, you got produce, meat, and ice cream during this time. That's elevating reefer demand as we head into July and August. So it's something that's really kind of expected. But if you look back to July of last year and compare it to now, we are significantly higher in rejection this time, same period this year as we were to last year. At the end of July and August, we expect that to go in the opposite direction. So right now, these next couple of weeks is going to be your peak time. Then you'll find that decline to come out in August, and it'll crawl across that 7.5%, 8% around August until we see that second surge that will come in for the holidays. But as right now, you're sitting at 11.9. And this is your opportunity to really run up what you can before things kind of soften out. So I would just expect continued upward pressure as those perishables continue to move. Now, the actual rate per mile that we're seeing on reefers right now is at 260. The high was 263. Excuse me, it's not 253. It's 263. So remember, 263, not 253. Rates have dipped a little bit, but had a significant jump, as you can see in comparison. We're right now about the highest as we were since mid-May. We're a long way off from where we were in December and January, but we are starting seeing some climbing out there as we start seeing that tender rejection change a little bit. Make sure you stick to the regions that pay you well and avoid those long runs that don't cost you, don't cover your fuel. So be very, very mindful of that and understand that it's going to take you more to run it. Protect your bottom line at all times. Then I wanted to share this chart too. I told you I was going to stick this chart in there, something that you can constantly monitor. Now, the data in this, it changes so quickly. So you got to be very, very careful on how you read this. But this allows you to kind of see trends. So now I remember last week we had a different case. Now we're at 325 net negative authorities at that point. Now we're seeing a different number this week. Right. So it's a different, as you see this week to week, this kind of changes out in terms of overall net. Remember, net is the difference between the carriers that enter versus the carriers that exit. So right now, as you see on your screen, we've actually added carriers, but every week this data changes when you go down to it, because you're going to have that reporting lag sometimes when it comes down from the FMCSA. I can tell you that from a data perspective, some of that data does take time to really kind of flush through, just because some authorities take time to go ahead and cancel themselves. So it definitely is one of the things is something that I want to keep you mindful of, because as you see a sustained net change, as you see a sustained net decline, that's when you start seeing volumes start changing. When you start seeing volumes start changing, that's when you can start seeing rates change. So as you see a sustained decline, or just more of a just stable changes in carrier net, changes in trucking authorities. And then if we start seeing the volumes pick up, those are the things that really can kind of change the market when it comes down to it. So keep your eye on that. And then the next thing that I wanted to share with you is this. This is one of the things that I would want to keep my eye on very, very closely because this is container volume coming into the United States. Take a look at where we are from container volume from now and just look back over the entire, let's go back into July of last year. We are starting to see a volume index, nothing we've seen in the last recent months. And remember, it takes about 4 or 5 weeks for this stuff to actually hit the truck. But this is telling us that there is some things that are brewing on the west that can drive volume. So I expect that volume to hit inland over the next 2, 3, 4 weeks. So I want you to get ready for a potential midsummer bump. So these are things that I looked at as we go through. And when you want a crystal ball, it's really hard to have one. But when you see freight that's pinning up, when you see outbound volumes where they're at, and then you see authorities where they're at, it kind of gives you a little bit of a, you don't want to say crystal ball because that'd be a lie, but at least gives you a little bit of understanding on what this market can look like over the next week, 2 weeks, definitely over the next 3 to 4 weeks out. So I definitely wanted to leave you with that. In closing, keep your eyes out on it because we're running post the 4th of July. So it's definitely something that could be different this week. So this will be the week that kind of tells us where we're headed. And make sure you tune in next week. Had a good time with you guys. Have a great week. Be safe out there. And make sure you keep your eyes on the prize.